Hey, what's up, everybody? It's Doug Shoemaker back with the Shoemaker Loan Team at Homestead Financial Mortgage. I want to clear up a little bit of confusion for you this week because it seems like there's a camp of people who say that every time the Fed does a Fed prime rate cut, that mortgage rates always seem to go up. It's not always true, folks. So let's get right to it for those of you who just don't have time to go through all the details and just want to know what time it is. So the Fed cut rates last month, and they may continue to do it again, but that doesn't automatically mean mortgage rates are going to go up or down. Markets are actually forward looking, so they usually price in these Fed rate cuts way before they even happen. Now, right now, all eyes are on the jobs data that's coming out on Friday, October 3rd. Now, if the labor market shows some weakness, more cuts are probably going to be on the table. If the labor market comes in stronger than expected, those cuts will probably get rolled back. Now, that's the quick snapshot. Now, for everybody else who wants to know a little bit more, dive a little bit deeper, maybe figure out how to build the clock, historically, Fed cuts don't directly cause mortgage rates to rise. The key is that markets, as I said earlier, they're always looking forward. Now, they often start adjusting weeks before the Fed rate cut even happens based on signals from the Fed. Now, here's a recent example. The Fed cut rates on September 17th. The 10-year Treasury actually closed that day at 4.07. So the very next morning, jobless claims came in much lower than expected, and that actually pushed those yields back up to 4.11. So it wasn't the Fed cut itself that moved rates, it was the surprise jobs data that actually moved rates. Now, rewind a little bit here. On August 22nd at Jackson Hole, Jerome Powell basically told the market he was going to be cutting rates. So at that time, the 10-year Treasury was at 4.32%. By the time that the actual cut happened in mid September, yields had already dropped by 25 basis points and mortgage rates fell even further. So that was the market anticipating the move, not reacting after the fact. So we've seen this before too. The Fed cut by 50 basis points on September 18th of 2024, and in the 2 to 3 weeks leading up to that, the 10-year Treasury yield had already dropped significantly, and mortgage rates fell by about 5/8 of a percent. Then, after the cut, things held steady until a surprisingly strong jobs report came in October and caused bonds to sell off again. So the same thing actually happened again in November and December of 2024. Rates were trending down until stronger than expected jobs numbers pushed them right back up. So here's the takeaway, everybody. Mortgage rates don't simply move higher or lower when the Fed cuts rates. Instead, the market is forward looking. And economic data like jobs and inflation reports, they can completely shift the direction. So looking ahead, the Fed is deeply divided. Some members see more cuts coming, others don't. The upcoming September jobs report on October 3rd is actually going to be critical. A strong jobs number could take more cuts off the table, while, as I said earlier, a weak one, it could actually keep them alive. So here's the bottom line. Don't just listen to the headlines. You've got to pay attention to the details and to the data because that's what the market does. And that's what drives your actual mortgage rates. Hey, as always, if you've got questions about this or how this impacts your buying, refinancing, or just planning for the future, give me a call or shoot me a message. As always, if you've got questions about how this impacts your buying, refinancing, or just planning for the future, give me a call or shoot me a message. I'm here to help you make sense of all this craziness. Thanks for watching. And if you or somebody you love needs some good, honest advice, I hope you don't keep us a secret.